Hey everybody, so in this video I wanted to talk about Palantir. Now there's a good reason why I want to talk about this company, and it's because I want you to actually see what is going on in the financials, because I don't want you to be fooled just reading these headline numbers. You have to be very, very, very cautious. Now Palantir has gone up after hours. I mean, it was over 10% plus. And what people really focused on was this GAAP earnings per share of 1 cent. Now, they said that this was basically their first quarter where they went GAAP positive. So they made a big, big deal out of it. And, it's very easy to get caught up in this because, management, they're making a huge deal out of this when really it is not a big deal. So GAAP is generally accepted accounting principles, and there are all of these complex rules in how they come up with this final number. And you can see it in the income statement. So we're going to go over to the income statement, and there's something I'm going to point out here. So we're just going to scroll down a little bit. So right here, we're going to see the income statement. The 3 months ended December 31st. Is what we want to pay attention to. So the 2022. So let's just go ahead and take a look at this. So revenue grew, so that's a good thing. Cost of revenue, it went up a little bit, which is understandable. Now, if you actually want to figure out what this cost of revenue is in comparison from 2022 to 2021, all you got to do is you just got to divide the cost of revenue by the actual revenue. So we could go ahead and do that real quick. Let's go ahead and run that number. So right here I'm going to do 104,311, divide that by 508,624. And what is that? Oh, okay, so that's 20.5%. So cost of revenue is 20.5%. Now let's go ahead and look at cost of revenue right here for 2021. So we're going to do 87,563. We're going to divide that by 432,861. And what do we get? Something similar. So, cost of revenue isn't really changing a whole lot. And then, obviously, if we do gross profit is pretty much the same thing. Get the gross profit divided by the revenue. So I'm not going to bother showing that. Now, here's what I really want to point out. What I really want to point out is the loss from operations. Now, keep in mind, this is loss, not gain from operations. So a loss from operations implies, through their normal business, they are losing money. So how is it that they are GAAP positive? So they are GAAP positive because, they're adding interest income. So they're making a whopping amount of money from interest. Now they have a little bit of interest expenses, so it's not a whole lot. Now look at this other income expense net. So somehow, through some method, some other income, not primarily through their primary operations, they made this amount, this $44,637. Now, these numbers are reported in thousands. So, add 3 zeros to that. So that's basically 44,637,000 is what they made from other income. So if you were to look at this earnings report and you say, oh, hey, they're GAAP positive by 1 cent, they could probably do this next quarter and the quarter after that and the quarter after that. Maybe and maybe not, but there is probably a big probability that it's the maybe not. Because as we see here, their primary form of operations, they did not make money. Where they actually made this money is from the interest income and this other income. And this other income, we don't even know what it is. But, we can try to figure out what this may be. Now, the thing is that this is a press report. It's not the SEC filing of the 10Q. So, we're not getting all of the details here, but we can make an assumption if we look for something very similar to this number in the cash flow statements. So it's a little bit harder to hide things in the cash flow statement. So this is kind of where we can go down and look at the items. So if we're looking at the consolidated or the condensed consolidated statement of cash flows, what we do is we get the operating loss, so we basically get the operating loss, and then from this we do all these reconciliations to basically get the cash amount. So I do want to point out that there is something here. Now let's see, where is it? Oh, it's right there. This gain from step acquisition. So what is a gain from step acquisition? I myself honestly don't know what this is, so I went ahead and looked it up. Now, there's this little article right here. This comes from PWC, which is PricewaterhouseCoopers. It is one of the big four accounting firms, so it's a pretty legitimate source. So right here, it says, an acquirer sometimes obtains control of an acquiree in which it held an equity interest prior to the acquisition date. Now, this is the highlighted part. In a business combination achieved in stages, the acquirer should remeasure its previously held equity interest in the acquiree at its acquisition date, fair value, and recognize the resulting gain or loss. So basically, it is saying, hey, you know what? We remeasured our equity stake in this company, and therefore, we realized that it was higher than what it initially was before the acquisition. Therefore, we are going to bump that value up, and it's going to show up in earnings. So that is essentially what is going on here, you guys. So do not be tricked. This company is still basically reporting negative GAAP earnings if you take that out. So, let's scroll back up here and let's take a look at this. So loss from operations, you guys, loss from operations. That is the key metric. If we go positive and we have a gain from operations, that is a very, very good thing for Palantir. But until we see that, thus far, I think that this earnings report isn't all that amazing. And, there's a lot of hidden variables here that are almost intentionally tricking people who aren't as in tune with these financial statements. So one last thing that I do want to say is that Palantir is actually positive on cash. So if we go down to this statement of cash flows, let me go ahead and look for it again. Let's see, where are we? There it is. So if we go all the way down to this bottom line right here, which basically says, let's see. Right here. So net cash provided by operating activities. So we're actually making cash right here. And the reason why is because we have some certain expenses that aren't necessarily cash expenses. So right here, depreciation, cash isn't really coming out of our pockets here. Same with stock-based compensation. Cash doesn't necessarily come out of our pockets from stock-based compensation. But you have to think about this. When you have stock-based compensation, you have dilution, and that's not good for the stock. So, basically to summarize this, you are still getting diluted through stock-based compensation, and the company is not necessarily making positive GAAP earnings through a organic means. So hope you guys enjoyed this video and have a good one.